Good day and welcome to the Q4 FY2023 earnings conference call of MPS Limited. As a reminder, all participants' lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during a conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and CEO. Thank you, and over to you, sir.
Thanks, Vikram. Good morning from New York, and welcome to our Q4 and FY23 earnings call. Today on the call, I have with me who is our CFO and joins us from Noida, Sukhwant Singh, who has recently been promoted to Chief Operating Officer of our India operation and also joins us from Noida, Tony Al, Senior Vice President and Head of Product Management, who joins us from Boston, Rajesh Jumani, known as Jones, who is our Chief Revenue Officer of our e-learning practice and joins us from Princeton, New Jersey. Sunit will kick things off in our opening segment today by discussing our financial performance. Then Sukhwant will update us on the new momentum we have developed in our content business. Tony will then update us on how our platform business is performing and entering an exciting phase. Jones will then discuss our robust performance in the e-learning business. And finally, I will summarize the outcomes of the board meeting and describe what has enabled us to achieve an accelerated trajectory towards Vision 2027. Let's get going. Over to you, sir.
Thanks, Rahul. On a quarterly basis, Q4 was better than expected, and the solid results were an excellent way to wrap up an impressive FY23 after a soft start in Q1 FY23. FX-adjusted revenues were higher by as much as 15.7% in Q4 FY23 compared to the last financial year. PBT grew even faster at 41.5% in Q4 compared to the same period in FY22. MPS achieved a new milestone with FX-adjusted revenue at INR 500 crores in FY23. We also surpassed our publicly stated goal of INR 100 crores in PAT and ended up much ahead at INR 109.19 crores in FY23. And while revenue grew 10.8% over the previous year, PBT grew 25% over previous year. Reflecting on the FY, here are my top 3 favorite themes. All business segments and lines of business are performing. We have returned to our roots as a high-margin business. Our top 15 customers now contribute towards 60% of our revenue, a much lower customer concentration than when we started this journey in 2012. I want to hand it over now to Sukhwant to discuss Content Solutions performance in FY23.
Thank you, Sunit and Rahul. So the post-pandemic momentum in our Content Solutions business continued in Q4 and for the whole of FY23. Given the significant operating leverage in our Content Solution business, as our revenues grew, our PBT grew by as much as 34% in FY23 and 47% in Q4. The scholarly line of business led growth in the Content Solution in Q4 and FY23 business. Some early signs of success in this business segment with the going gestalt growth strategy include a revised go-to-market strategy, which is basically a new market-based approach which enabled unlocking growth synergies between scholarly content and platforms and educational content and e-learning. We did step up our efforts on cross-selling and upselling with a specific focus on star accounts, which led to a robust growth in all top 10 Content Solution customers and a double-digit growth in 3 out of our top 10 accounts. In terms of launching new capabilities, we launched a new peer review solution that is proving to be highly successful with a significant multi-year win in Q4 of FY23. This was with a prestigious new customer. We also significantly invested in new AI/ML-based image and research integrity solutions and saw noteworthy demand for these services as well. I would like to now hand it over to Tony to discuss Platform Solutions performance in FY23. Over to you, Tony. Thank you.
Thank you very much, Sukhwant. In quarter 4 of fiscal year 2023, the revenue in the platforms business grew by 2.4% over the same period in fiscal year 2022. The performance in the second half of FY23 was our first signal of growth in this business segment in our third year of ownership of Highwire, and it has laid a strong foundation for fiscal year 2024 and also for the years ahead. I can confidently state that our platform business has now transitioned into a healthy and growing phase for the following reasons. One is that our mission has now transitioned from a support and delivery to product development. This includes new product launches, active product roadmaps, and upgrades. Another reason is our new customer acquisition strategy that has involved product and service bundling. Price warriorship is gaining traction and is helping us to develop a new customer base. And the feedback from the industry and the scholarly community is highly encouraging. Highwire and MPS offer the only serious independent choice since two of our larger competitors have been acquired by publishers. So I now want to hand it over to Rajesh to discuss the e-learning solutions performance in FY23.
Thank you so much, Tony. E-learning is now the second largest business segment. Revenues were at INR 127 crores in FY23, which is 25% of our total revenue. Profitability improved by more than double during the financial year 23 and more than 50% in Q4. By Q4, all 4 entities were performing, including the Swiss entity, which had finally recovered from the decline during the pandemic. The acquisition of EI Design confirmed the validity of a new acquisition playbook of acquiring growing assets and compelling valuations. In addition to substantial financial indicators, including significant margin improvements, operational indicators were also highly positive. We are now market leading in service delivery and quality in the e-learning practice, reflected in high CSAT scores across the portfolio. Growth operations in e-learning practice have matured and are setting the benchmark for other business segments. The soft launch of Imagine, which is an experience center business, was highly successful. We completed a marquee project at India Energy Week earlier this year, and the Honorable Prime Minister also appreciated our work. The business did exceptionally well in its first year as an independent business unit and performed on richer margins than the e-learning business. My team and I are committed to scaling Imagine to a sizable business segment for marketing communications by FY25. Back to you, Rahul.
Thank you for the rich update, team. Our new growth strategy has started to deliver strong business results. A 5-prong approach has powered the recent momentum, what we refer to internally as going distort, which includes the revised go-to-market strategy that Stefan mentioned, a stronger emphasis on cross-selling and upselling in star accounts, the addition of new customers across business segments, the launch of new capabilities, and an unprecedented pace of integration of EI Design into MPS. Now to go over a couple of board outcomes. In the previous board meeting in April, the board approved raising of funds through the issuance of equity shares of the company or any other equity-linked securities of the company or other securities convertible into or exchangeable for equity shares by way of qualified institutions placement QIP in one or more of the tranches for an aggregate amount up to INR 250 crores. Subsequently, this matter was also approved by the shareholders. This is an enabling approval for a period of 12 months. Today, we have a healthy deal pipeline and are in active discussions with multiple targets and have taken these approvals to keep momentum if large opportunities become available. Based on experience, we will not raise these funds unless we are extremely confident they can be deployed within 2 quarters. This approach allows us to progress efficiently if and when large opportunities do present themselves. I am pleased to share that based on the unprecedented earnings growth in FY23 and an EPS of 63.87 rupees, the board of directors has recommended a final dividend of 20 rupees per equity share for 10 rupees each of the companies. Given the upcoming acquisition, our board has taken a balanced view on return to shareholders. This approach allows us to go ahead and acquire healthy and growing assets, albeit at compelling valuations, and significantly enhance shareholder value. It was also discussed at the board that once this phase of acquisition is complete, we would return to previous high levels of distribution. Additionally, this form of distribution need not be at the end of our financial year and could be sooner if the acquisitive phase is completed more shortly and surplus funds become available. Let us now open the call to questions.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Kindly restrict to 2 questions per participant. If you still have more questions, please join the queue afresh. Take our first question from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Rahul, really indeed a very good result, but I would like to advise something. Do not take it as a criticism. You are doing good things, but we did QIP in past maybe 8 to 10 years back, and our company shares didn't rise any thereafter. You are again doing QIB for 250 crore, but your decision sell down the market cap of company more than 250 crore. So please request you reduce the dividend, raise the debt instead of QIP, because raise of equity is always costly incident. So please do not raise any equity now, please. This is my decision, which I am saying since the company last 10 years. That's why I had given this decision to you, advice to you. Thank you.
Thank you. We take the next question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, I'm also on the same line as the previous speaker. Sir, we distributed 357 crore during the past 5 years. Sir, thank you for that. Sir, but you would appreciate that 23 to 35% of that payout got leaked in the form of taxes to the government from the shareholders. So now this year again we have distributed 50 crore dividend and we are raising 250 crore of QIP. So instead we can just cancel the dividend and raise 200 crore if need be. So what are your comments on this?
Sure. So the focus for all of us at MPS is our Vision 2027, which basically is tripling our revenue to take us from 500 crores to 1,500 crores by FY28. In terms of, there's an organic growth strategy that is going to help us unlock that, and there's also an inorganic strategy. We expect 60% of this scale up to come from acquisitions and 40% of the scale up to come from organic growth. With respect to the QIP, I think as I shared in the opening remarks, this is an enabling approval for a period of 12 months. It is for a raise for up to 250 crores, so it need not be 250 crores, for example. Additionally, like I mentioned, this is only if large opportunities present themselves, and we are confident that those large transactions can be completed in 1 or maybe 2 quarters post the raise. So that is kind of the background on the QIP process. In terms of, there was also comment on question on debt earlier as well. So on that, I think we've basically taken a view that if we are open to debt, so we're not completely averse to debt, but overall we do not want to raise any debt beyond the annual cash flow from the operations or the annual profit after tax, which is 110 crores. So from our perspective, while that may not sound very exceptional to the astute financial minds, we are risk averse on that, and the primary reason for that is we've diligently worked to scale the business, and we don't want to do anything to risk and derail the business. With respect to redistribution, as you've seen, we have historically executed a much higher distribution than what you've seen in FY23 in terms of percentage of earnings or percentage of cash flow. So yes, given the upcoming acquisitions, we have made a more modest distribution this time because we plan to invest that towards acquisitions. Having said that, in terms of the shareholder base, we must respect that while we do have large institutional investors, we also have individual investors who potentially would prefer dividend over buyback. So we're trying to create a balance that basically makes sure that capital is redistributed efficiently. We continue to invest, given the high ROC available in the business today, which is in the early 30s. There are lots of opportunities to reinvest the capital. And finally, how we distribute dividend versus buyback, that's something that we take a balanced view on at the board level whenever we do distribute the capital.
Sure, sir. Sir, also, last call also this matter was raised about chat GPT and AI. So the apprehension is that since our basic competitive advantage comes from our low-cost operations in India, etc., sir, but going forward, sir, this might neutralize the edge that we have in terms of, if chat GPT or other AI instruments, so they can flatten the field. Instead of 10 people hired in US, if we have 15 people in India, so currently 15 people in India are more cost effective versus 10 people in US. So, but maybe chat GPT will basically change the dynamics to one person in India versus one person in US. So can you just explain to your layman shareholders how we are basically our business is intact despite developments in AI?
Yeah, sure. So, good question. So we see this as a positive. We operate in a highly fragmented market, $300 billion market growing at 15%. The largest player is only 300 million. So this market, is ripe for consolidation. And whenever, there's shocks to the market, that consolidation gets accelerated, and, MPS has and will continue to play the role of a consolidator. In terms of, the cost arbitrage, I think one of the key things we must understand is that our customers need partners like MPS that are intelligent and scale to execute on these technologies. A lot of the know-how and the innovation when it comes to production of their work normally sits on the supplier side. So currently, for example, we are running many pilots and programs in collaboration with our customers where we are actually executing on these frameworks. These frameworks are difficult to execute independently for our customers. They need partners like us. And the cost arbitrage continues to be important because what we are seeing is what these frameworks are providing is a start to the work, not a complete production of the work, because there still needs to be a subject matter review or some kind of formal review before the content of a learning module is released. So we see it as a huge positive. We are embracing AI and ML into various parts of our business. And we see on the content side it helping us with speed, efficiency, also therefore improving our margins, continuing improvement in margins in the content business. On the platform side, it has enabled us to create some very exciting new products because a lot of our competitors are not as adaptable as MPS, so we are going much faster than them. And then on the e-learning side, we have integrated with a lot of third-party solutions again to improve speed and efficiency. So I think we have to view this in context of our space in our industry, which is, so on the customer side, they need support to understand what all of this is and execute on it. On the competitive side, given that the market is highly fragmented, there are only few handful of scaled players like MPS. It gives us as scaled players an opportunity to consolidate the marketplace. So from a competitive situation, we are thinking of this as a huge positive. There's a lot of investment that is taking place within MPS. We set up a unit called MPS Labs based out of Bangalore to pursue this very actively. So there's a strong investment in product and development in R&D at MPS to execute on AI numbers. So we see this as a huge positive and going forward a differentiator for MPS.
Okay, sir. Thank you very much.
Thank you. A reminder to participants, if you wish to ask a question, please press star one now. We take the next question from the line of Dipesh Mehta from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First, just want to get sense about we have seen significant improvement in our margin profile over the last few quarters. So how one should look segment-wise margin, because content and platform is now already over 40% margin. E-learning already around 25% margin. So from margin versus acceleration in growth by making investment, what would be the thought process of management, whether we reach to some margin level where we aspire to, and now incremental focus would be on accelerating revenue growth, or you think still we can manage both in terms of revenue growth with margin? Second question is about the on platform side. We indicated about new product launch and we have a active product roadmap. So if you can provide some sense about where we are making investment and what is the product roadmap. E-learning, we highlighted good traction in marketing communication. So if you provide some more detail. Thank you.
Sure. I'll defer to Tony on product and Jums on the marketing communications business experience center business Imagine. So to kick it off on margins, as we've shared before, our business has tremendous operating leverage through a combination of two things. One, we are a tech-enabled business, so anything that we produce, is enabled by tech. Wherever we can automate, we automate. Where we can't automate, we have system-based delivery. We have some automation, and then comes in pre-delivery. So, and the second piece of course, this is a large percentage of our workforce is present in tier 2 cities, which gives us a cost arbitrage. So, from a margin perspective, as revenues expand, margins will continue to grow. Unfortunately, unlike previous calls where I gave you very specific guidance, I will not be able to do that because as you announced a QIP, based on SEBI regulations, we're not able to share that tight forward-looking guidance like I used to share. So we will not be able to share specific guidelines, but at a high level, I can share that we expect margins to expand growth due to the tremendous operating leverage available in the business. In terms of the platform business, I'd like to set Tony up by of course, I want him to discuss the product launches that we're planning in FY24. But before that, I also want him to provide some context on what's changed. What is the perception of Highwire in the marketplace? How has MPS ownership changed things? So Tony, if you can give that color first and then talk about product launches. Over to you, Tony.
Thank you, Rahul. Sure. So, to address the topic of the perception of Highwire in the marketplace, Highwire has been exceptionally visible in the marketplace, and there's been really an increase in outreach through our marketing efforts, through client visits, and attendance at industry conferences. And it's been really, really exciting as I travel around and I visit with clients and I attend these conferences. I'm continuously complimented on Highwire's resurgence, and I get feedback on how happy people are. There are more options, especially in the area of content hosting. This renewed and refreshed perception of Highwire has made our current clients very happy that they've stuck with us. It's made our past customers think about returning. It's put Highwire back on the RFI and RFP list when publishers are looking to change their vendors. So it's been the perception has been really, really positive. And the change in perception, it's really possible because of the MPS acquisition. MPS has unlocked a suppressed potential by investing in the technical staff, allowing us to resume a lot of the stalled projects and platform implementations. It has provided, MPS has provided real marketing muscle, getting the word out about Highwire. MPS has had strong platform products in the past, and we've been able to combine those with the Highwire platform offerings. And this means that Highwire has a well-established and really, really strong end-to-end selection of solutions that are addressing the entire scholarly and academic publishing process. So it's a really, really positive and exciting story. And the result of all of that is that we've been able to move forward with product launches, or to move forward with our roadmaps, which will allow some really exciting product launches coming up. I'm really excited about the upcoming release of the web version of our e-commerce and subscription management system called Think Web. Think Web, it's the web platform of Think. It provides new revenue opportunities through the upgrading of existing customers, as well as an opportunity to expand our customer base. We're also really excited about the launch of our analytics product, Insight Visor, which it provides useful business analytics to publishers. It helps them find new sales opportunities and optimize opportunities with existing clients. And alongside Insight Visor, we're enhancing our Impact Visor analytics product with trends data. This will provide predictive analytics to customers who want to upgrade to this premium service. And then this fall at the Frankfurt Book Fair, we're going to be launching an MVP of a new modernized workflow platform. This has been there's been very little innovation in publishing workflow systems over the past 2 decades. And in fact, our competitors still use 20-year-old monolithic systems to manage their mission-critical processes. So we've seen an overwhelming call in the marketplace for more flexible, modular, microservice-based platforms. And our new platform will help consolidate workflow, reduce time to publication, using a single-source publishing model. And this will vastly simplify workflows, and it will allow for really easy integration of AI and machine learning tools and services. And finally, we're upgrading and consolidating our technology stack for our content hosting systems, and this will help improve margins because it will allow us to operate far more efficiently and onboard more clients more quickly.
Thanks, Tony. Thank you for that rich update. All the best in FY24 and looking forward to the platform business now entering an exciting growth phase. James, over to you. If you can talk about what is an experience center business, what is Maginu, and why it could become our 4th business segment called marketing communications.
Sure, Rahul. Thank you so much for the opportunity. To just put it in a layman's language, the experience center business or Maginu as a new business line focuses on creating physical and digital immersive experiences. What it means is we take physical spaces and we convert it into very high-end technology-enabled digital spaces. So imagine yourself walking into a museum, and the museum has lots of technology like you saw in movies like Star Trek or, in Star Wars and places like these. So these are typically created for large corporates who want to create what they call brand museums. So if some visitors walk into a large company headquarters, instead of taking them through a regular PowerPoint or somebody talking about the business. They actually taken around an entire brand museum, shown the past, present, and future of the group. Similarly, lots of B2B organizations are creating what they call executive briefing centers or strategic briefing centers. So when they invite customers to come into their offices to showcase futuristic products, instead of putting them into a room and taking them through PowerPoints, they again walked around into a museum kind of a environment where they are shown what the company is going to do in the future and how it benefits the customer. This is becoming a very, very new trend, not just globally, but also in India currently. We've done some very exciting projects for large corporates, and the market is looking extremely bullish for us. A few differentiations over here from a regular business. This business allows us, obviously because the values of the deals are fairly large, you're selling directly to the CXOs, the chairman, the CEO, but also your main point of contact becomes the chief marketing officer and chief of corporate communications, which is all marketing oriented. And obviously we all know marketing budgets are much higher than typical training budgets. So these are typically high value projects. They have a lot of annuity business linked to it, because once you create an experience center, there's lots of updates that happens to the experience center year on year. There's lots of maintenance activities, there's lots of support activities that happen over there. Similarly, this is clearly a new niche for us to focus on. There are not many players in the market who are right now organized into creating turnkey projects for customers. We, for example, do everything from space design to creating of the visitor choreography to the content, the interiors, software, hardware, support, all the AV that goes in. Very, very few players do this, so there's a clear niche for us that we can create in this marketplace. Thank you, Rahul.
Thank you.
Thanks, Jones. Thank you for the update. Again, very excited about the future of Imagine You and a new business segment getting created for MPS. Thank you for the update. Back to the questions.
Thank you. We'll take a next question from the line of Rahul Jain from Dolat Capital. Please go ahead. Rahul Jain? Yes, sir. You are now. Please go ahead.
Yeah. Hi. Congratulations to the team on a wonderful year. Just want to understand your thought in terms of what kind of growth you expect across the segment. Bulk of the growth right now is led by this one traction which we have now found in the e-learning space. But from a steady state basis, what should be the objective that we should be chasing here on an organic basis? And any more input you would like to share on the content and platform side, content side, what could be the base for this business a couple of years from now? And also a similar thing if you could share on the platform business.
Thanks for your question, Rahul. So I think the North Star continues to be Vision 2027, which is to get to 1,500 crores in revenue at similar margins by FY28. As I stated earlier, 60% of this growth will come from acquisitions, 40% of this growth will come from organic growth. As I shared earlier, I would love, and I'm in a position to, give you more tighter guidance, but unfortunately, because of these, I'm told the regulations are very restrictive once you announce the QIP process. So I'm unable to, my hands are tied. I'm unable to share tighter guidance than that. Having said that, I think we got a nice update from Tony on how the platform business has finally entered a growth phase. We got a nice explanation from Jones on marketing communications and and the e-learning business generally doing very well. So I'll just add to that and talk a little about the content business, because that continues to be a large part of our business, and what we've basically seen is organic growth in this business over the last couple of years, which we are continuing to be very bullish about, that this growth will continue and margins will continue to expand. And what's kind of changed in terms of this business is a lot of our customers are now transitioning into becoming subscription businesses. What that has done is, when you're a subscription business, your differentiator and your draw for a customer is really your content. So there's a renewed focus on time to market. Customers are looking to target unprecedented turnaround times on time to market, which basically means players like MPS that have a lot of smart technology that can enable that tend to do better. So MPS, of course, has this MPS Labs HQ out of Bangalore, which is constantly innovating, has been around for a bit, has seen a significant scale up and reinvestment in AI and ML over the last couple of years. So that is becoming a strong differentiator for us in the content business. We are also seeing a new wave of outsourcing in the content business. We are seeming to be moving upstream. Customers are looking for support on lots of upstream activities, which they previously were not looking at. On the scholarly side of our business, for example, MPS is now starting to get involved in the manuscript submission and peer review phase. On the education side of our business, accessibility is a big trend. In addition to that, our proven track record, especially during disruptions, like I stated before, the Chennai floods, COVID, post-COVID, has given our customers a lot of confidence in our ability to execute in not always perfect conditions as well. So even when the operating environment is suboptimal, MPS has delivered on time and with excellent quality. Again, that also the input to that is, of course, the seamless tech that we have as IP, as well as our low cost model, which allows us to ramp up quickly. So that has given us a lot of momentum because like I said, customers are transitioning to a subscription business. They need partners that they can depend on, and our proven track record enables that. On the education side of our business as well, we've seen a change in customer profile. So earlier we were restricted to educational publishers. Today we work with educational institutions, we work with edtech companies, learning companies. So our scope of market in the education space has expanded, which is also giving us a nice lift in the content business. We are also seeing on the education side a new wave of outsourcing, which is focused on digital. So we've been able to, unlock the IP and the, synergies between our content business and our e-learning business, and have created kind of this new offering called digital learning for education. So that's been an additional kind of tailwind that we've got going. So, to summarize, one of the things that was missing, if you look at our history from 2012 to 2020, maybe, we were pretty much growing inorganically. And what's changed for MPS now is, we finally have organic growth. Content is growing, e-learning is growing, platforms is growing. Organically, we are looking to develop a fourth business segment. And then inorganic growth then becomes and kind of has a multiplier type of effect where there's obviously, if you're growing as a business, good double-digit growth organically, and then on top of that you add more inorganic growth, that then kind of supercharges things. And there's obviously synergies between whatever we will acquire between the current business and the new business. And our updated acquisition playbook is we are looking only at growing assets. Assets that have inherent financial strength, so they are also growing. So, overall, very, very optimistic. Feel super confident about this goal that is stating for FY28. 1,500 crores for MPS at similar margins is not an aspiration, it's not a dream, it is a conservative goal.
Right. And one bit more, if you could say on the content side, where you said this movement to subscription is something which is driving the momentum. So I'm sure this is happening for quite some time now. So where you see, we are in that cycle, you think bulk of it is behind us, or you see this is a tailwind at least for next few years, or could be more short term than that?
Good question, Rahul. So, yeah, I think there's been a lot of talk about this for a while, but in terms of action and execution, I think it's been limited. So, for example, the big four in education publishing, not all of them have transitioned to subscription businesses. They do have subscription products, but they're not really subscription businesses. We've seen more of that on the scholarly side of our business. So I think there's more ahead, less behind. Also, from a business model perspective, as our customers become subscription-based businesses on the content side, the exciting part of that is that it's also allowing us to become subscription-based business on the content side, where we're entering into, for example, content as a service agreements with some of our customers. And again, we have one example in our content business where a customer has transitioned to this model. So there's a lot more ahead. And of course, we all know, when you, with a subscription-based business, you have, high recurring revenue, which helps you to improve your margins, also gives you a lot of predictability in terms of future revenue, which allows you to invest and grow the business. So yeah, I think, Rahul, there's more ahead and less behind right now in this particular transition in the content business.
Sorry, just if I would like to add one more question to the same point, which is on these, I know you are tied up on the outlook, but just to understand the basic maths, if you see this 500 crore revenue purely on an organic basis going to 900 crore, this could mean 12-13% kind of a CAGR. For this year, FY24, I'm sure e-learning would be driving it on a relative basis, given the run rate that we have. But beyond FY24, you think this would become slightly more balanced with all three space contributing, give or take, to that number, or you think e-learning, given the potential opportunity, would continue to clock much higher pace and will drive the overall growth momentum for the business organically?
Yeah, I think to recap what our CFO said in his opening remarks, one of the most positive indicators is that all lines of business are now growing. So earlier we had this choppiness where, we had one segment grow, the other decline, one was flat. I think the big change, like I said, is we finally have organic growth. And we finally have organic growth for each of our business segments and each of the lines of business within those business segments. So that's a big change. In terms of math, I won't question the math, Rahul. I think it's fairly straightforward. The goal is to get growth from 500 to 1500, 60% coming from, inorganic, 40% coming from organic. Again, like I said, I'm unable to give you tighter guidance. I am in a position to, for the first time in many, many years, we are in a position to give that type of guidance, but unfortunately the regulations don't allow us to. So hopefully, later on in the year, we can provide tighter guidance and information. All I can say right now is we are optimistic about the future. We've set a conservative goal of 1,500 crores. We have a strong track record. Firstly, we don't give much guidance, and when we do give guidance, we tend to be conservative, as you saw in our PAT guidance for FY23, which we beat. So, that's all the intelligence I can provide at this stage now.
Right. Just congratulations to the entire team for getting the growth back, as also to the finance team to get back the margins we used to do earlier. And best wishes for your strong aspirational outlook. We wish you achieve it ahead of the schedule.
Thanks, Rahul.
Thank you. We take the next question from the line of Vivek Gautam from GS Investments. Please go ahead.
Yes, so congratulations for a good set of numbers. And I'm a recent investor in your company, so don't mind if you can just sort of, there would be many more like me, because the company seems to be consolidation for a very long time and not much was happening. But what changed in the recent quarters that the visibility and the business has improved, and is it sustainable?
Yeah, thank you for your question, and again, thank you for entering. Maybe your luck is rubbing off on us. so do stick around. So from my perspective, I think like I was talking earlier, what has changed is we finally have organic growth. We've always been really good at acquiring distressed companies, spending 5 years to turn them around, and then going to the next one. What was missing for us was organic growth, and it's basically been a pivot, a change in strategy. So a couple of years ago, the pandemic gave all of us, including the MPS management team, a lot of time to pause and reflect and think about how do we unlock growth in this business. So 2021 we internally introduced this growth strategy that we call going Gestalt, which at this point we've only executed at a very small scale. So the first element of the strategy is, instead of trying to sell a platform or a content project or an e-learning project, we're approaching the market through a market-based approach. So we have a revised go-to-market strategy. So we are attacking 3 markets today: the scholarly and research community, the education community, and finally the corporate learning marketplace. And what we do in this situation is, we position ourselves as an innovator, and the people representing us are representing firm-wide capabilities rather than individual products and services. So this has, led to us unlocking synergies across all the IP and the acquisitions that we've created over the years. So a very, very strong leg of our growth strategy. The second piece of this has been also on a stronger emphasis on strategic customers. So we today have over 700 customers. For a 500 crore company, B2B in the learning and tech space, it is unparalleled. Far is we picked the top 10 from each of the business segments. So we picked the top 10 customers from content, top 10 from platforms, top 10 from e-learning, and we've kind of made a focus on how do we grow these 10 customers. And as a result, we started to see that feedback. Of course, as in the next phase, the goal will be to take this 30-star account and make them 100 as we scale. Now that we're confident that this strategy works. The third element has been, our aggressive pursuit of new customers. So, again, this includes customers in new markets, customers in existing markets, and each of the segments have a different strategy of how to unlock this type of customer base. So, for example, as Tony was describing, on the scholarly side, it's a price warriorship and product bundling approach. On the e-learning side, it's more positioning ourselves as an immersive technology partner, as Jums was describing. And on the education side, it's about we're looking beyond publishing into education institutions, colleges, learning companies, edtech companies, as well as a stronger emphasis on digital learning. Then also, one of the things that we've been doing over the last few years has been a constant reinvestment in new capabilities. We had 3 launches last year. So we launched a peer review solution that Sukwant was talking about. We launched Imagine. We launched Macless Now. Going ahead, we are launching three other products as Tony described already. There's a lot of focus on investments in new capabilities, both from a product perspective, but also from an efficiency perspective. So, embracing AI and ML as we produce our work through MPS Labs. And finally, the updated acquisition playbook. We executed that on a very small scale with ER Design. So, ER Design was not a very large company. It was the first bite of a healthy company. And we've seen the effects. We've seen margin expansion. We've seen revenue growth. We've seen customer diversity. So, it allowed us to be more active in APAC, India, Middle East. I think what's giving us the confidence is we created a strategy coming out of the pandemic called Going Installed. Very simple. If you think about it, it's a very simple. There's nothing very complex here. It's a simple organic growth strategy, and it's really been about excellent execution. We've executed on a very small scale over the last couple of years, and now as we go towards FY28, now that we're feeling confident as a management team that the strategy works, the focus is now how do we supercharge this strategy? How do we throw more gasoline on this momentum? So that's kind of the context on what's giving us so much confidence.
Very good reply, sir, and very detailed one. Increases the confidence in the company. And sir, one thing we more wanted to know about this QIP plan. Do you have an acquisition in mind? And last time it took a long time, it seems. And then what is the business visibility in Q1 FY24? How is it happening? And by when this QIP plan or this acquisition might materialize, sir?
Yeah. So like I said at the top of the call, we have, basically got an enabling approval for a period of 12 months. We are looking at multiple targets right now. We have multiple conversations going on. The potential raise is up to 200 crore, up to 250 crores. We learn from our experiences, right? As a business, as a management team, we've gone through many experiences over this journey since 2012, since we bought MPS from Macmillan. And we are committed that we will only execute a raise like this if we can deploy the capital in a quarter, maximum 2 quarters. If we don't have very, very strong conviction around that, we will not execute on this raise. So again, enabling approval for a period of 12 months, raising up to 250 crores. It's very, it's impossible for us to give you an exact amount of the fundraise. It's impossible for us to give you the timing. It's just the regulations are very restrictive. So I humbly would request that be patient. 12 months is not a long period of time. So once things happen, we will definitely be the first to make an official announcement when we can.
Yeah, sir. And congratulations here that AI Design, the last acquisition was really APS accretive from day one. And let's hope more such acquisition will happen and help us in the long term. Thank you very much. Keep up the good work, sir. Thank you.
Okay.
Thank you. We take a next question from the line of Guneet Singh from CCIPL. Please go ahead.
Hi, sir. Thank you for this opportunity. So, as a layman, I just want to understand the kind of product offerings that we have. So, our verticals of content and e-learning, which content basically is providing content solutions and creating content for our customers. So, I mean, what kind of content would we be offering to educational institutes like Stanford or other universities when they are the ones who should be driving content in the first place. So, what kind of products do we offer in the content space to them? And also, how is our e-learning offering, what does our e-learning offering entail, and how is it different from creating content for our partners? So, as a layman, I just want to understand the business a bit more.
Sure. So we don't have much time left, so I'll go ahead and quickly answer the complete question. So, our customers are, so just to start with, who is our customer? Our customers are scholarly and research, customers, people in that community, people in the education community, and people in the corporate learning space. So that's our customer. In terms of our segments, so we have 3 segments. We have content, platform, and learning. On the content side, we are possibly the most comprehensive player in terms of capability. So we offer everything from content creation to delivery across all media. So within this, we provide content authoring, development, learning design. Where content has to be sourced, we also provide rights and permission solutions. We also provide media asset development and creative studio services. All of the production and the content that we do enable for our customers is powered by digital workflows. And where a customer has been slow on their digital journey, we also enable a digital transformation. content is the majority of content solutions is the majority of our business, and our value proposition here is that we enable speed and efficiency for our customers, and also we help them create products that are differentiated in their marketplace. On the platform side, we again have the only provider that has a complete range of configurable solutions. So we offer these solutions as platform as a service across the entire content lifecycle. We were the first to market. We are leader in the space. We are the innovator in the space, and we have products in the submission, peer review, and workflow space. We have products in the hosting and identity management space. We have products in insights and analytics. And finally, we also have software as a service products in customer service and order management. Here, our positioning is slightly different from content. We are positioned as innovators and thought leaders. And again, this business has now entered a growth trajectory. On the e-learning side, we work with organizations to deliver high-impact learning and performance support solutions, making sure that they deliver a high ROI for the learner and the organization. So within this, we offer learning and development, advisory and consulting. We do custom e-learning. We do more experiential and immersive things like simulations, games. We also help with training delivery, operate in new technologies like AR, VR, and XR. And again, we do have learning technologies and platforms that we license and host for our customers. The value proposition here is that we tend to offer more experiential and transformative type of e-learning rather than plain dry e-learning. So that's kind of a summary of who we are as an organization. And like I said, our customers are from the research, education, and corporate industry.
All right. So thank you very much. That was helpful. I just have one remark that, with ChatGPT coming in, with the simple query, people are able to create whatever kind of content they want. So, for example, even coding a game on ChatGPT has been done in the recent months. So, this might have an adverse impact on the content creating business. I heard your conversation about ChatGPT not affecting the company in an adverse way. But what would be your thinking on this?
Yeah, like I said earlier, we are seeing this as a positive. I do know that there are companies that are not investing. So we see a positive impact because we see this as a market consolidation process. Customers want to work with fewer, intelligent, and scaled players such as MPS. And our customers, the way they've kind of structured internally, they don't have the horsepower to execute on some of these new age technologies. They need partners that can help them understand what this all means for them, but also reconstruct the value chain, reconstruct solutions. So yes, how we do business is going to change. What you see behind all the numbers that you see in our results, the work that goes behind that, the operations behind that, all of that is going to be transformed. Having said that, we still feel that there's a lot of value that we can add in terms of helping our customers unlock this change and the value of this change. But also remember that we are in the learning space. So a customer cannot have a situation where they have a learning program where they have content that they don't have rights to, they don't have permissions to use the content, or it does not meet the objective of the learning program. So we see AI ML being an enabler of faster time to market. We see it as making us more efficient, and we also see it as helping us consolidate a very, very fragmented market. We don't see it as a threat. We see it, at least in our position as a market leader, we see it as a huge positive for us to make things happen for our customers.
All right. Thank you very much for the explanation. I wish you all the best.
Thank you.
Thank you. Take the next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi.
For the opportunity again, just a couple of bookkeeping question, more on the margin improvement in this quarter. So some of this improvement also came because of absolute drop in certain cost. So can you explain, especially on the other expenses side, is this the run rate, business run rate now, or there was some thing missing in this quarter which should recoup in Q1? Similarly, what would be the wage hike and overall employee expenses growth one should envisage for 24?
Yeah, again, keeping the clock in mind, I'll go ahead and answer the question on behalf of our CFO. So, two things. So on the core employee benefit expenses, there has been a reduction primarily due to offshoring. So we've seen a significant drive from our customers as well as internally towards moving, to India and also tier 2 cities in India. We've also seen improvement in productivity and service delivery as we embrace technology. So this is not a one-off. It is a trend that we continue to improve. So it's primarily due to offshoring as well as more automation in the workflows. With respect to other expenses, we've rationalized, infrastructure costs by introducing hybrid work policy across overseas and expensive locations. So, for example, in the UK, US, Switzerland, Mumbai, we've gone to a different kind of a setup. So again, this rationalization is complete. The hybrid environment will continue. So this is the run rate that you can expect on the other expenses side.
Sure. Thank you. That's it.
Thank you. Take the next question from the line of Aditya Shivana from Niveshaay. Please go ahead.
So I have congratulations for this set of numbers. I have a question that what would be the segment mix in the upcoming future?
Yeah, thank you for your question. Like I shared earlier, because we've announced a QIP, we are unable to share, tight guidance. What we can confirm is that finally we have growth in all three segments. All lines of business are growing, and we are very optimistic about the future. It's good, unfortunately, even though we have the data and we are able to share that information, we are unable to because of regulatory framework.
Okay. So I have a new question that what would be the order book in e-learning business?
Yeah. I think the e-learning business for us is continues to grow. Again, that's a forward-looking question, so can't really share specific data, but we've unlocked a new trajectory in e-learning, and we expect to sustain and grow that trajectory.
Okay, thank you.
Thank you. We'll take the next question from the line of Rohit from iThought PMS. Please go ahead.
Yeah, hello. Am I audible?
Yes, you are. So please go ahead.
Yeah, hi. Congratulations, Rahul, on great numbers and performance by the team. Rahul, my question is on the content solutions business. So over the last probably 4-5 years or probably even more, while we've been taking market share away and consolidating, but there was always that being compensated, the higher volume being compensated by fall in prices. And as a result, that business was largely stagnant. Now, you talked a bit about some changes that are happening, but structurally, what is really leading to growth in this segment specifically? And do you think this will continue, or this is more like a cyclical kind of revival after so many years of flat growth?
Yeah, I think, like I said, what's changed is many of our customers are transitioning into subscription-based businesses. So historically, if I was a textbook publisher, I would produce X number of textbooks. I would look at my, marginal cost, my marginal revenue for additional product. And, investment in product development would be super tight because, I was in this catch-22 situation. Should I produce more product or not produce more product? what's changed, of course, is because they've moved to subscription-based models, what differentiates them in the marketplace is more product, more product and more compelling product. And as a result, it's created this very interesting pressure on the supply chain to produce faster. And because of which, not everyone has been able to step up from a tech standpoint, but also from an operational efficiency standpoint to deliver on that customer aspiration. As a result, scale players like MPS are acquiring more market share. The tail is getting wiped out. So that's one perspective. The second perspective also is because our customers have to produce faster, they have to now start looking at things beyond what they're outsourcing. So currently, many of the customers are outsourcing a certain part of the value chain, and they realize they've squeezed everything out of this chain in terms of time to market. If they were producing 3 months, they're now producing it in 3 days. But there's another part of the value chain where no innovation has happened because that's always stayed internal. So, on the research side, for example, once an article is submitted, it takes 180 days to accept the article. But it only takes 3 days to publish the article once it's accepted. So now our customers are saying, you guys have helped us crash one part of the value chain. Come along the journey with us to help us crash the more important part of the value chain. So there's an aspect of, we are now more differentiated in what we do, and therefore gaining market share. But also we have this new wave of outsourcing that has opened up to us because our customers are saying, we need help in also disrupting this part of the value chain. So it's a combination of increased market share as well as increased market power, if that makes sense.
Got it. Understood. And in terms of, a large part of the issue in this over the last many years was again that the economics of your customers was challenged because of the nature of that industry and how things have changed. Do you think that will again come back and sort of be an impediment for continuous growth, or do you think that the structural change will sort of give more wings to you and the tailwind will continue?
Yeah, customers, continue to look for new avenues of growth. As your, and if the unlocking of that growth comes with only with new product development, the most efficient, at least in our world, in the markets that we operate in, the most efficient form of product development is outsourcing. Our customers have not been able to unlock that internally, and we do not expect them to be able to unlock that because they're not as well staffed as they used to be, for example, a decade ago. Because there's so much pressure on product development and fast product development, it's enabling us to, it's giving us a larger opportunity. And of course, we are also, because we are doing a lot of this through tech and wherever manual effort is required, we're doing this through tier 2 cities. We tend to be more cost effective as well. So they want to produce faster, cheaper, better. And, we're enabling that purpose.
Got it. Thank you very much, Rahul. This is very helpful and all the very best. Thanks.
Thank you.
Thank you. We take the next question from the line of Rishikesh Kale, an investor. Please go ahead.
Yes. You mentioned last time that you would go with debt and equity financing only if the acquisition size is with revenue of more than $30 million. So does the QIP indicate that there are such opportunities coming?
Yeah. So like I said, I confirm that, we will only unlock the QIP approval if we are confident that we can deploy the capital in 1 or maximum 2 quarters. That's data point number 1 for you. Data point 2 for you is that we are not 100% risk averse on debt, but we are conservative with debt, and we will not finance debt above our cash flow from operations or our annual PAT. Now, like I said, earlier, that we are restricted by regulatory framework. I've given you data points. Please reduce.
Thank you. Thank you, and excellent results. Thank you very much.
Thank you.
Thank you. We take the next question from the line of Deepak Kumar, an investor. Please go ahead.
Yeah, hi. I'd like to understand what the end use of the cash actually. The PAT was around 110 crores, but the cash only increased to, probably there's a shortage in cash at 10 to 15 crores. So just wanted to understand that. Have you done some investments? Because I see the receivables have not increased.
Yeah, I think that's something that my CFO and I fight about very often. Basically, there's no change in business. We do have a much larger customer base. So we have over 700 customers now. So it's really about how do we tightly manage that piece. There has been very little change in business. I let Sunit now make a quick comment. We of course had that acquisition happen in 2022, but Sunit, if you want to chip in, why is there this disparity between cash flow and that?
Yeah, thanks, Rahul. So we had received advance from customers, and those advances got adjusted in this year. So that was one of the reasons that the cash flow, when you're looking at it, to some extent get impacted without adversely any affecting because the debtor ratios have improved. The debtors have otherwise.
Yeah. Everything seems fine, and suddenly the cash there is a drop. So that's why, if you look at the fact, I believe the cash has gone to 210.
Yeah. So that's the main reason. Otherwise.
Yeah, having said that, we have a continuous improvement mindset, so we want to improve this. We don't want to just take it for granted.
Sure, Rahul. And very good result.
Thank you.
Thank you. Take the next question from the line of Arjun Goel, an investor. Please go ahead.
Hi, Rahulji. I wanted to understand from you, you've touched upon this earlier. When you talk about your Vision 2028 for 1,500 crores of revenues, based on what you're seeing in terms of the ground realities, can you achieve that without diluting equity? Like, it may not be 12 months from now, but 18 months from now or 24 months from now, will we see a situation where, QIP might be maybe coming in? So just wanted your thoughts on that.
Yeah, excellent question. I completely understand your intent. If I was in your position, I would be asking the exact same question. Having said that, again, regulatory framework, we have to keep giving you this, scripted response which says we've taken approval of raising up to 250 crores. However, the exact amount of the fundraise and the dilution will only be known at the time when we launch the QIP. We powered ourselves with enabling approval for a period of 12 months. Today, we have a healthy deal pipeline and an active discussion with multiple targets.
No, but strategically, I'm so sorry to interrupt you. I know you're talking time.
You're asking me a question I can't answer.
Okay. Fine, fair enough. Sir, I got that.
I hope I can answer a question later on in the year.
Okay. And I don't know if you can answer this also, but can you, I know when you look to acquire newer companies, you look at various factors, but as investors, we would be looking at whether they will be EPS accretive or not, right? So I hope that when you look at perspectives, that is a very important consideration that you give to the companies. So that's number one. And secondly, I would lastly request you that to use the QIP as a resource of last resort, any others before that dilution lasts. Thank you.
Noted. Thank you for your recommendation. And again, on the acquisition opportunities, I can share more information because you shared this previously. We are looking at businesses that have growth momentum. We're looking at they should have inherent financial strength. So yes, they should be EPS accretive, but they should also be not just EPS accretive for 1 year. We want them to continue to grow. Independently, of course, we'll unlock synergies, but there should be a baseline level of growth. In terms of the types of companies that we're pursuing, we're looking at e-learning companies that enhance our capability or improve our geographic diversity. We still continue to be limited on geography. There's lots of markets that we have not unlocked yet. We're also looking at education opportunities where we can work with educational institutions, universities, colleges, etc., in a more direct way. We're also looking at opportunities that, Jums talked about the marketing communications vertical and a jumpstart we've gotten from the launch of Imagine. But if we do get an opportunity to scale that quickly, that's another area we're looking at. We're also looking at opportunities that allow us to move, like I was describing earlier, more upstream in the value chain where we can unlock value for our customers. And finally, we're also looking at platform opportunities. So those are kind of the 5 types of domains that we're looking at in terms of acquisitions.
Great. Thank you.
Thank you. Take the last question from the line of Mahesh Ria, an investor. Please go ahead.
Hi, Rahul. Can you clarify that if a big acquisition comes up, you will fund it with debt to the extent of 1 year of cash flow and the remaining from equity dilution?
Yeah, I can't confirm that. What I can tell you is that we have available to us an approval that allows us to raise up to 250 crores. So we don't have to raise 250 crores, but up to 250 crores. And as a management team, we are okay with raising debt if needed up to 110 crores, basically the cash flow from operations.
But you will consider debt first and then equity?
I cannot comment on that, because of the regulatory framework.
Okay. Thank you.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session, and I'd now like to hand the conference back over to Mr. Rahul Arora for closing comments. Over to you, sir.
Yes, thank you everyone for your excellent questions and insights. Please do note that we take all of your feedback and your outside in view very, very seriously. So that has really enabled us to be smarter in our approach over the last, especially the last 2 or 3 years. And we look forward to you pushing us and challenging us like this. We are a humble management team and are always open to excellent feedback from the community. So please keep it coming. And from our perspective, we stay very, very committed to our Vision 2027, which is to get to 1,500 crores by FY28 at similar margins. So thank you for all your support, and I look forward to continued support as we head towards our vision. Thank you so much.
Thank you very much, sir. Ladies and gentlemen, on behalf of MPS Limited, that concludes this conference. Thank you for joining with us. You may now disconnect your lines.